Now, a report by Parthian says the re-emergence of geopolitical risks underscores a more complex backdrop for the bond market as investors maintain a more cautious stance in the month of March. However, in the fixed income market, the report also notes the bullish appetite of investors on the back of improved liquidity. Gafar Bashiru, fixed income trader at Parthian, joins me now to unpack the report and discuss the outlook for the second quarter of this year. Thank you so much for joining us on the show today, Gafar, and it's good to be back after the long holiday. But let's start, before we get into the nitty-gritty of the fixed income market movements we've seen so far in the first quarter of this year and what we should likely expect this quarter, let's look at the macroeconomic overview from consumer price index, monetary policy direction we've seen so far, and then even looking at the Gulf tensions and how we've seen oil prices move.
Yeah, we've seen consumer prices, inflation drop in Q1 to about 15%, and that was well much telegraphed from last year, and it also informed the Monetary Policy Committee's meeting in February, where they cut rates by 50 basis points. The central bank noted that, or the committee noted that they would be cautious and ensure that further cuts, potential cuts, would be data-driven, right? Now, with the geopolitical tensions posing fresh risks, it now means that we would have to deal with imported or energy inflation, potentially, with higher energy prices, but also imported inflation from commodities and other imports that Nigeria will be bringing into the country. And that basically sets the tone for what to expect in Q2 2026, right? We've seen just 50 basis points cuts this year. Going into Q2, with this fresh inflationary risk, it's likely that we might not see any cuts in the May meeting by the Monetary Policy Committee. And that would mean that as far as bond yield is concerned, we might see yields higher for longer.
And talking about yields higher for longer now, looking at the bond market in particular, the yield movements and the sort of demand we've seen so far, walk me through your take around the bond yields we've seen so far, the allotment strategy we've had from the Debt Management Office. And then when we're looking at the bigger picture, with our yield movements, now it looks like it's the global geopolitics by shifting things rather than domestic fundamentals. Walk me through your take around this. And the big question we also ask, especially with regards to the budget, with the way we are moving at this point in time, are we approaching what we will call a fiscal credibility ceiling for bond investors?
So now, the good thing about the bond market is we are now trading more on fundamentals, right? It's been said over and over again that the new CBN administration has meant that markets trades more with fundamentals. Now, the reason why bond yields has been trading in correlation with the developments in the Middle East is because, like what I just pointed out, wherein if we have higher prices, higher oil prices, while on the one hand the federal government is going to benefit from improved government revenue, on the other hand, it provides inflationary pressure, right? And that would mean our benchmark rate would remain higher at 26.5 where it is, and that would mean that there will only be an opportunity for yields to drop. Also, on the flip side, right, where what would keep yields anchored and not continue to climb is the fact that because government is getting more revenue, they wouldn't have to borrow as much. So supply of securities into Q2 would not be as significant, right? And that would also mean that would keep yields basically anchored within a specific range of around 16, basically around the 16 handle, right? Towards the end of last week, we also saw the new reports where the federal government is planning to increase the borrowing plans for 2026, right? Which is going to borrow externally, and that also, would translate into would translate that the DMO wouldn't be under as much pressure to borrow. So that is also, when you look at factors that could push yields higher and you look at factors that could push yields lower, you can see that there's some sort of counterbalance.
Less than 2 minutes to wrap up this conversation, but when we look at the T-bills market and then money market at this point now, looking at the liquidity paradox, you take around what you should also expect near terms, and then when we also look at the Eurobonds and also the global drivers within that regard, we have oil shock, we have Feds, and then the geopolitics. Let's talk about the nuanced play we should expect.
So in terms of the T-bills markets, thankfully we have some sort of bifurcation between the Nigerian Treasury bills and the OMO bills. The OMO bills, because we have more FPI players in the OMO segment, we're seeing it also correlates with the geopolitical tensions. In terms of the NCBs, we are seeing it trade largely based on local factors, which is largely the DMO borrowing plans. For Q2, they plan fresh borrowings of about 750 billion, right, which is not so significant, right? And that would mean that we could see some volatility where yields go down and then up depending on liquidity supply at that point in time. Unlike the bond market where we might see yields range bound or trend higher a bit.
Gafar, thank you so much for your time. That was Gafar Bashiru, fixed income trader at Parthian.